If you're paying mortgage insurance, you want to cancel it as soon as possible. And when I chat with clients about this topic, I always outline the most relevant details for most people, but there's actually more to know. And in this video, I'm going to give you the quick and dirty, but I'm also going to shade in the rest of the details. And some of the details are backstory, but watch to the end for a little known cheat code that could help you cancel mortgage insurance years sooner. And because seeing numbers can be really helpful, I'm also going to work out how MI might play out for a home buyer today. Now, before I get into the weeds talking about how to get rid of mortgage insurance, I feel like I should take just a second to explain what it is and to an extent to defend it. Mortgage insurance kind of gets a bad rap, but mortgage insurance, or MI, is really just an insurance policy that covers a portion of your lender's losses in the event that you default on your loan and your lender has to foreclose. And lenders they worry about this, and they basically figured out that they're covered and should break even if your mortgage is no more than 80% of the property value. So if you make a 20% down payment, which puts your loan at 80%, then your lender is covered, and you've protected them from the risk of loss if there is a default on a mortgage. And this is why so much popular advice focuses on putting 20% down. Your granddad and Dave Ramsey want you to put 20% down because banks want you to put 20% down. But what if you don't have 20% down? With less than 20% down, your lender's pretty much guaranteed they're going to lose money in a foreclosure situation. And lenders worry about this. So they could just tell you to go pound sand and come back with 20% down, but that would make it pretty difficult, maybe impossible, for a lot of us to buy a home. So that's where mortgage insurance comes in. If you can't, or if you don't want to put 20% down, you can just buy an MI policy for your lender. The MI company will cover a portion of the lender's losses if there's a foreclosure. And now your lender is perfectly happy to make you a loan with a smaller down payment. And that's all MI does for you, nothing more, nothing less. It lets you put less than 20% down on the purchase of a home. Once you have that foot in the literal door, MI has served its purpose, and now we want it to go away as soon as possible. And I should also get some bad news out of the way. If you've got an FHA or USDA loan, you probably only have one way to get rid of mortgage insurance, and that's refinancing. Mortgage insurance on most FHA and all USDA loans runs for the full life of the loan with no option to cancel it ever. Your only option to get rid of it is to refinance. So the focus of this video is going to be getting rid of monthly mortgage insurance on conventional conforming mortgages. And these are the loans funded using money from Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac are often talked about interchangeably. I do it all the time, but when we talk about canceling MI, there are key differences between the two agencies. So before we carry on, take a second, maybe hit pause, pop down to the description below, and use the links I've shared to look up your loan and figure out if it's owned by Fannie or Freddie. I'll wait. Oh, hey, welcome back. Now we know who owns your loan. The bank named on your mortgage statement is your loan servicer, contracted by Fannie or Freddie to collect payments and handle the other day-to-day business in connection with your loan. You're going to work with your servicer to cancel your mortgage insurance, but your servicer is just following a playbook that's given to them by either Fannie Mae or Freddie Mac. Okay, so with that established, we can forge ahead. So I promised I'd cut to the chase and share some quick and dirty information, the rules that are relevant for most people in most cases. And these rules only apply if you want to cancel MI on a single family primary or secondary residence where you live, or a vacation property, a cabin or a beach house. If you live in a 2, 3, or 4 unit property, or you want to cancel mortgage insurance on a rental, keep watching. I'll share everything you need to know later on, but let's say you want to cancel MI on your home or vacation property. You're eligible to request cancellation after both of the following are true. First, you have to have your loan for 2 years. Second, you need to demonstrate that you have sufficient equity. The amount of equity required, sufficient equity, depends on how long you've had your loan. You need to have 25% equity to cancel MI right at the 2-year mark, but once your loan's been around for 5 years or more, you only need 20% equity. And equity is just the difference between your property value and what you owe. If your home's worth $500,000 and you owe $400,000, you have $100,000 of equity. But when you call your lender asking them to drop MI, they're probably going to start talking about your loan to value ratio. And your LTV is just the inverse of your equity. Your equity is the percent of your home value that you own, and your LTV or loan to value ratio is the percent of your home value that you owe. If you have 25% equity, you're at a 75% loan to value ratio. 20% equity is an 80% LTV. You get the idea. So to cancel MI, you need to be at 25% equity, 75 LTV after 2 years, or 20% equity, 80 LTV after 5 years. Pretty simple. Simple as this is, in the real world, way too many people wind up paying mortgage insurance for years past the date they could have canceled MI. Life gets busy and it's easy to lose track of time. And if you're not thinking about selling, you may not be keeping super close tabs on your home value. I'll confess, I think I paid MI for at least an extra year or two on a house I own just because I lost track of it. I wasn't thinking about it. And I know this stuff and I do this for a living. And I don't want this to happen to you, so permit me to share my patented, foolproof 3-step system for canceling mortgage insurance the moment you're eligible to do so. And okay, it's not really patented, but it is really foolproof. Step 1, stay in touch with your real estate broker. And this should be easy and fun. You liked and trusted this person enough to be your guide to buying your home. Catching up now and then, maybe over a tasty beverage, shouldn't be a hardship. Step 2, set a calendar alert for 2 years after you bought your home. And while you're at it, save a link to this video with the alert. Step 3, when that calendar alert pops up, grab your latest mortgage statement. We have a little math to do, and then we need your realtor's help. When that alert goes off, find your current mortgage balance and divide it by 0.75. Let's say you owe $450,321. 453,321 divided by 0.75 equals $577,335. Now, call your real estate broker up and ask, is my home worth, insert whatever your resulting number is, and if your agent says yes, reach out to your loan servicer and request cancellation of your MI. But keep watching this video for more information. I'll explain the process you can expect as you go through it. If your broker says your value isn't quite high enough yet, then reset that alert for 6 or 9 or 12 months down the line and repeat. And then remember, 5 years after your purchase date, if you still haven't been able to cancel your mortgage insurance, you now only need 20% equity. So you can start dividing by 0.8 instead of 0.75. Now that we have the basics out of the way, let me talk about more of the details. And the details are really best framed up by knowing that there are 3 options for canceling mortgage insurance. There's an automatic option, there's an option based on the original value of the property, and an option based on the current value of the property. And some of these rules actually come from legislation that was passed back in 1998. It was called the Homeowners Protection Act, or HoPA, and it applies to all single-family primary residences with private mortgage insurance. HoPA carves out those government-provided mortgage insurance programs, FHA and USDA loans. That's why they can't be canceled. And although HoPA only covers single-family primary residences, Fannie Mae and Freddie Mac have kind of generously extended similar rules to single-family second homes. Again, that's your vacation property, your beach house, your cabin in the mountain, or whatever. HoPA includes rules for automatic termination of MI and also rules for borrower requested termination of MI based on the original value of the property. Now, although I don't have stats to back this up, from experience, I am confident the majority of MI cancellation doesn't happen under HoPA. and you really shouldn't wait for HoPA to kick in. If you do, you probably paid thousands more in mortgage insurance than you could have. But first, let's talk about the automatic cancellation rules, which are part of HoPA. MI on a single family primary residence will automatically drop off when you reach the first of two milestones. The date your loan is scheduled to reach 78% of the original property value, or the first day of the month after the halfway point of your original loan term. For this automatic cancellation to kick in, you also have to be current on your loan. And for lenders, current means you paid your loan payment, the prior loan payment to the month you make the request, within the month it was due. It was due on the 1st, you paid it before the end of the month. Now, HoPA doesn't require it, but Fannie and Freddie generously extend these same rules to canceling mortgage insurance on single-family second homes. Again, that's a vacation property. And Fannie Mae is even more generous, offering automatic termination in 2 other instances that aren't covered under HoPA. Now, Freddie offers no automatic termination of mortgage insurance on a 2 to 4 unit primary residence or on rental properties. And this is the first of a few ways in which Freddie is not as nice as Fannie when it comes to MI rules. But on a 2 to 4 unit primary residence or an investment property, Fannie will drop your mortgage insurance automatically on the first day of the month after your loan hits the halfway point of the original term. That's kind of a mouthful, but on a 30-year loan, that would be month 181. It's basically 15 years and a month into your loan. Now, it's really nice that this fail-safe exists in case you fall asleep at the switch, but again, don't wait for automatic termination. I'll show you how much this might cost you using the example at the end of this video. Next, however, I want to talk about the borrower requested options. To take advantage of these other options, you have to take action. The ball's in your court. You have to know about these options and make a request. The first and simplest is borrower requested, that's a mouthful, borrower requested cancellation based on the original property value. So for a single family primary or secondary residence, you can request cancellation as soon as your loan balance is paid down to 80% of the original value. And there's no waiting period required. As soon as your loan is at or below 80%, you can request your lender drop mortgage insurance. So we do need to talk about what is the original value. If you used your current loan to buy your home, the original value is the lesser between what you paid or what the house appraised for when you bought it. If your current loan was a refinance, the original value is the appraised value for that refinance. And that's a number that probably isn't likely to have stuck in your head, so you may need to dig up a copy of the appraisal. And if your loan didn't require an appraisal, which is sometimes the case, you'll have to dig a little deeper and pull up a copy of the loan documents and just look around for a property value. Or you can always call your loan servicer or call the lender who helped you set up your loan. If you're my client, if I helped with your loan, feel free to call me. I probably have those records for you. Now, once you know the original value, we're going to multiply it times 0.8. So let's say you paid $500,000 for your home. 500,000 times 0.8 equals 400,000. So in that example, once you pay your loan down to whatever that number is for you, jackpot. Drop what you're doing, call your loan servicer, request that they cancel your mortgage insurance. Now the rules are different if you live in a 2 to 4 unit property or you want to cancel mortgage insurance on a rental property. Fannie wants your loan at or below 70% of the value, but Freddie Mac wants your loan at or below 65%. So multiply that original property value by 0.7 for a Fannie Mae owned loan or 0.65 for a Freddie Mac owned loan to figure out what your target value is to cancel mortgage insurance. And when you reach out to your loan servicer, they're required to do 2 things. First, they have to verify that you have an acceptable payment record. And second, they have to verify your current property value isn't less than the original property value. Before digging into these rules and talking about the methodologies, I want to talk about the second borrower requested option. borrower requested cancellation based on the current property value. If you want to take advantage of the appreciation since you purchased your property to get rid of mortgage insurance, this is the option for you. And in my experience, this is the most common option used to cancel MI. And what I had in mind when I talked through the quick and dirty rules earlier in my not patented but still foolproof 3-step method to make sure you cancel MI as soon as possible. So we talked about this before. Once you've had your loan for 2 years and can prove that your loan is down to 75% of whatever your property value is up to, you can request termination of your MI. And once you've had your loan for 5 years, you only need to prove that your loan balance is down to 80% of whatever your property value is up to. And these are rules for single family primary residences. For 2 to 4 unit residences, a primary residence with 2 to 4 units, or a rental, the rules are a little different. And both Fannie and Freddie are going to require that you have that minimum of 2 years, but after that point, Fannie Mae requires 30% equity and a 70% loan-to-value ratio. Freddie Mac requires 35% equity and a 65% loan-to-value ratio. We already talked through how to reverse engineer the value you need, but we'll recap it here. For a single-family primary or secondary residence, divide your loan balance by 0.75 if you've had your loan for 2 years, 0.8 if you've had your loan for 5 years. For a 2 to 4 unit primary residence or a rental, wait 2 years and then divide your current loan balance by 0.7 if your loan is owned by Fannie Mae, or 0.65 if you're owned by Freddie Mac. And if your property value is at least the resulting number, whatever that is for you, you are eligible to request cancellation of your MI. Reach out to your loan servicer to get the process started. And with the option to request cancellation based on your original property value, your servicer is again going to require an acceptable payment history and require evidence of your property value. You have an acceptable payment history if you check 3 boxes. Your loan has to be current, which means your prior month's payment was paid before the end of the month in which it was due. In the past 12 months, you can't have had any 30-day late payments, and in the past 2 years, you can't have had any 60-day late payments. And Freddie Mac, ever the stickler, expands their requirements to include just a couple of other considerations if you're asking for cancellation based on your current value. They won't approve your request to cancel if in the year before you made the request, you transferred ownership in an impermissible way, or you failed to keep up your property taxes or ground rent or homeowners association dues if you are in a community with HOA dues or you're in a condo, or if you didn't maintain your property. And yeah, they can refuse to cancel your mortgage insurance if you've not kept your property up. Of course, your servicer needs evidence of the current value of your property too. And Fannie Mae's process starts with their servicing solutions system. You can think of this as a fancier proprietary version of a Zillow Zestimate. Your loan servicer can log into their system and ask for an estimate of your property value. And if the value is high enough, you're done. Your MI will drop off. There's no need for an additional evaluation of your property in any way. But if the servicing solutions value is too low, or maybe it couldn't generate a value, you'll either have to pay for a broker price opinion or an appraisal. The fees for these run from as little as a couple $100 to $700 or $800. And the appraiser or broker assigned will visit your property and generate, as the name implies, an opinion of value. If your BPO or appraisal comes in high enough, your servicer has to notify you within 30 days and cancel your mortgage insurance. If your BPO or appraisal is too low, then the servicer will let you know what the value is, and they're going to give you the option to pay your loan down to hit the required level to cancel mortgage insurance. And if you don't want to make a lump sum payment, you can just hang tight and wait for your home value to go up more and try again later. But it's a bummer to jump through these hoops and maybe write a check only to find out that your MI won't be canceled, which is why you want to stay in touch with your real estate broker. Lean on their expertise to help you assess the value of your home, and then only ask for MI cancellation when the odds of success are high. Now that was Fannie Mae's process. Freddie Mac's process is pretty much identical as Fannie Mae's minus a step. Freddie doesn't offer a digital evaluation. So for sure with Freddie, you're going to be paying for a BPO or an appraisal. We have two more topics to cover: the cheat code to speed up cancellation and a real world example. So let's talk about the cheat code. To cancel MI based on current property value, your loan has to hit the 2-year mark. We talked about this a couple times, but there's an exception. If you can show that the market value of your single family primary residence or vacation property has increased due to substantial improvements, the minimum 2-year waiting period is waived. And better yet, if you qualify for this exception, you only need 20% equity and 80% loan to value rather than 75%. To qualify for this exception, you need to make substantial improvements, remodeling kitchens and bathrooms, adding square footage, energy efficiency improvements, installing air conditioning, your cosmetic updates to paint and fixtures, plumbing and lighting fixtures, that's not substantial enough. And repairs and maintenance, like replacing a roof or like-for-like replacement of, say, worn-out flooring with similar new flooring, isn't considered an improvement. Now, Fannie Mae rules are a little vague. They simply require that you provide details about the improvements that you've made since you closed your last loan to your loan servicer when you make the request. But Freddie Mac gets a lot more detailed and requires that the BPO or appraisal includes specific information about the nature, the extent, the date and cost of the improvements that you've made and their impact on value. And Freddie also requires that any improvements you've made comply with local zoning and building codes. Now let's get nitty-gritty and look at each option for canceling MI and how it might play out in the real world. And to keep things as real as possible, the numbers I'm going to share are based on the loan a real client is using to buy her home right now. At the time I'm recording this, she's about a week away from closing. I'll call her Annie. It's not her name, but we'll go with Annie. So let's get to it. Annie is paying $415,000 for her new home, putting $25,000 down and borrowing $390,000. Her mortgage insurance premium is 0.42% of her loan amount annually for the first 10 years, and then drops to 0.2% of her loan amount beyond that until it drops off. So first, let's figure out what Annie is going to pay for MI each month. To do this, we multiply the loan amount by the MI premium and then divide by 12. $390,000 times 0.0042 equals $1,638 per year. Divide by 12 and you get $136.50. After 120 payments, Annie's premium is going to drop to 0.2, so $390,000 times 0.002 equals $780. Divide by 12 and we get $65 per month. So Annie's initial monthly payment will include $136.50 of mortgage insurance, and then starting at payment number 121 after the first 10 years, her premium is scheduled to drop to $65 a month. The 3 paths to canceling mortgage insurance are automatic, borrower requested based on original value, and borrower requested based on current value. And then we have our cheat code option if she makes substantial improvements. So let's run through each. First, let's look at the automatic cancellation, which is whichever comes first, remember, the month after the midpoint of her loan or when her loan is scheduled to be paid down to 78% of the original value. Annie's financing her home with a traditional boring old 30-year fixed rate loan, so the midpoint is 15 years. So let's convert that into months. We'll multiply 15 times 12, we get 180, and then we're going to add a month to that. So the month after the midpoint of her loan is 181 months. Easy enough. But how do we figure out when Annie's loan is scheduled to be paid down to 78% of the original value? Well, it turns out with the right tool, this is easy too. It's a 2-step process, and step 1 is just to figure out what 78% of the original value is. Annie's paying $415,000 $415,000 times 0.78 equals $323,700. So that's our target loan amount. To figure out when Annie's loan is scheduled to be paid down to this level, we need to use an amortization calculator. Now, I keep one on my desk all the time. I poke at it all day long, but for this calculation, I'll use my favorite online calculator. I've put a link to the calculator in the description below if you want to follow along. First, I want to enter Annie's initial loan amount in the box for principal. That's $390,000. I'll leave the payments per year at 12, and I'm going to change the interest rate to 5.99%. That's the rate we locked in for Annie a couple of weeks ago. We'll leave the number of payments at 360 for a 30-year loan, and you leave the balloon payment blank. That should always be blank or 0 if you play with this calculator in the future. And I'm going to check the Show Amortization Schedule box and then hit Calculate. We just figured out that Annie's monthly loan payment will be $2,335.74, but to find what we're really after, we need to scroll down with an eye on the far right column, the principal balance. That column shows the amount Annie is scheduled to owe after each of her monthly payments. And what we're looking for is the month that her loan balance drops below our target $323,700, and here it is, month number 124. If Annie does nothing after 124 months, her MI will go away. So how much will Annie pay for MI if she waits for her automatic cancellation? Her premium starts out at $136.50 a month, and she has to pay 120 months at that threshold. $136.50 times 120 equals $16,380. Then her premium drops to $65 a month for 4 more payments before going away. 65 times 4 equals $260 plus $16,380 equals $16,640 of total MI cost. Now, Annie may not pay just the minimum payment on her loan. If she pays extra, it will save her a bunch on interest and put her on track to pay her loan sooner, but it won't change the date her mortgage insurance will automatically go away. Automatic cancellation is based on the date that her loan was originally scheduled to be paid down to 78%, regardless of how much extra she does or doesn't pay. Now let's see how the borrower requested options play out. With no waiting period, Annie can request cancellation of her MI as soon as the loan is paid down to 80% of the original value. So let's multiply her $415,000 purchase price by 0.8 and we get $332,000. Hopping back over to our amortization schedule and scrolling down, we can see that Annie's loan balance is scheduled to drop below $332,000 after 111 payments. So if Annie picks up the phone and calls her loan servicer after 111 months, her servicer verifies that her property value hasn't dipped below what she paid, her MI could drop 13 months earlier than the automatic cancellation date, which will save her as much as $1,488.50, bringing her total MI cost down to as little as $15,115.50. But what if she pays extra along the way? Remember, there's no waiting period for cancellation based on the original value. So as soon as Annie's able to knock her loan down to $332,000, she can request cancellation. If she adds just an extra $100 to her payment every month, she'll cut her loan down from 360 to 322 months. She'll save a bunch of interest, and she'll also hit the magic $332,000 in just 94 months, reducing her MI costs to as little as $12,831. And if she pays more, or maybe comes into some extra money sooner and can pay the loan down faster in a lump sum, she's free to request her lender to drop mortgage insurance at any time. Next, let's move on to the most common path to canceling MI, borrower requested cancellation based on the current property value. If Annie follows the advice I gave you earlier, she's gonna set a calendar alert for 24 months after she closes on her home purchase, and in 24 months, she'll owe, again looking at our amortization schedule, $380,108. at the 2-year mark. That's at 24 months. Now remember, she needs to have 25% equity and 75% loan to value. So let's figure out what her home value needs to be. To do that, we take her current value, $380,100, and her current loan balance, rather, $380,108, and divide it by 0.75, and we're going to get $506,810. So if Annie's home goes from $415,000 today to $507,000 in 2 years, she'll be eligible to request cancellation of her MI right at the 2-year mark. Now that would take about a 10.5% annual rate of appreciation. And here I have to state the painfully obvious. No one has a crystal ball to say what home values are going to be over time, certainly not me. And although a 10 or 11% rate of appreciation isn't unheard of, that's faster than normal. The long-term rate of appreciation for Annie's market, where she's buying, is 5.65% a year. If Annie's home appreciates at the normal 5.65 per year rate, it would take 3 years and 8 months for Annie to have sufficient equity to get rid of her MI. $136.50, her monthly MI premium, times 44 months, 3 years and 8 months, equals $6,006. That's not bad. She's lowered her mortgage insurance cost a bunch, and that's without taking into account any extra amount that she might pay to bring her loan down at a faster rate. So what about our cheat code? If Annie makes significant improvements that increase the market value of her property, remember, she's not subject to a waiting period, and she only has to show 20% equity, 80% loan to value. So let's say she spends her first year of homeownership making meaningful improvements to her home, diligently working away. At the end of the year, looking at her amortization schedule, she's slated to owe $385,202. So let's figure out the value she'll need to get rid of her MI. $385,200 divided by 0.8 equals $481,503. So with normal 5.65% appreciation, her home value over the course of that year would go up to about $438,000. So she only needs to make improvements that add another $44,000 of value, and she'd have enough equity to cancel her MI in just a year, bringing her total MI cost down to $136.50 times 12, just $1,638. So here's how those various options compare. Automatic cancellation will take 124 months, and Annie will pay a total of $16,640. If she pays nothing extra, she'll get to 80% of her original value and can request cancellation based on her original value after 111 months and could save almost $1,500. And she can accelerate that even more by paying extra. If she adds just an extra $100 a month to her payment, she'll get to the 80% mark in 94 months and could save $3,800 relative to waiting for automatic cancellation. And if her home value appreciates at a gangbusters 10.5% interest rate, she might be able to request cancellation after just 24 months, but that does seem a little bit optimistic. So if she gets a normal rate of appreciation, she should be able to cancel her MI in just 44 months and save over $10,000. But if she plans to make improvements, things look even better. With average appreciation and improvements that add at least $44,000 to her value, she could request cancellation in a year, dropping her total MI cost down to $1,638, generating over $15,000 of savings, again, relative to waiting around for automatic cancellation to happen. I hope you can use this information to save some money. Please like and subscribe and comment below if you found this information helpful, if it got you on the path to saving, and reach out anytime you find yourself in need of a loan to buy or refinance a property. I'd love to chat and help out.